So to buy stock on margin or to trade options, you must apply for a margin account with your broker. When you're buying and selling options on margin, it is not really margin, but a good faith payment. All right, so if you want to trade options, there's 3 different levels, right? They have 1, 2, and 3. The first level, you apply for it with your brokerage firm. They'll let you sell covered calls, they'll let you sell cash secured puts and stuff like that. Then you have your 3rd level where they allow you to sell all different type of option strategies. But you have to get a margin account to sell options, to buy and sell options outside of the cash account. So you want a margin account, you need at least $2,000 to do that, okay? So the very entry is only $2,000, right? But when you're trading options, the way I teach people and the way we talk about in these meetups is that you're not using margin. They use those words margin, because that's the terminology they use, but it's not really margin when you're trading options. It's really a good faith payment that you're putting up. You're putting money in escrow, okay? So the best way I like to explain it is that if you are looking to buy a house, you find a house that you want to buy, you see a sign in the yard that says for sale, right? You go, you look at the house, you agree with the seller, and the seller agrees on your price, and then the seller goes back out and they change the sign in the front yard to sell pending, okay? They change the sign to sell pending. Well, the seller, by doing that, you have to give the seller a good faith payment. And that good faith payment all depends on how much the house is, you're buying the house for, but let's just say it's for $5,000. And you give them that good faith payment just in case you renege on buying the house. Because the seller, when they put that sign in the yard that says sell pending, they are basically taking their house off the market. Because most people are going to drive by their house now, right? So they lose an opportunity cost, right? But that $5,000 that you give good faith to that seller, that can go towards your actual loan, okay? That can go towards it. You don't actually lose it unless you back out of the terms, right? So with option selling, you sell something and your risk is put into escrow, okay? And you're not paying any interest on that, but that's just there just in case something goes wrong or just in case you renege. But it's really just in case something goes wrong, it goes against you. All right, so let's say this is company ABC, okay? And you want to sell a put spread in company ABC. And when you sell a put spread, you are what?
Bullish.
You're bullish, right? So let's say you sell this put spread at the 90 and you buy this put at the 80. So you're selling this one and buying this one. So this is a 10-point wide spread. It's a 10-point wide spread. You sold it. And when you sell something, you have to put money into escrow. You have to put up that good faith payment like we were just talking about. And because it's 10-point wide, each point equals $100. Okay? Each option equals 100 shares. Each point equals $100. So this is one option we sold, right? We sold a put spread, but it's a 10-point wide put spread. So it's 100 times 10, which is 1,000. Okay? So in regular T margin, they're going to require you to put up $1,000 to make this trade. Okay? Probabilities are still on your side because let's just say this is a 10 delta or something. Okay? This is the delta over here. Let's see if you got a 90% chance of making money. If this was a $100 share, then it needs to go down 10% before it goes past your short strike. Okay? So, but you have to put up $1,000. And what's interesting about this is that that's your max loss. You can't lose more than 1,000 minus the premium you receive. So you're going to receive something like this. You're an insurance company, you sold this. Let's say you receive $100, just for easy math. You receive $100. So your max loss is what now? 900, because you get to keep that $100 regardless of what happens. You get to keep that $100. Okay? Because just like in a car insurance company, you get in an accident, they're going to keep your premium and they're just going to use that towards the car accident if they have to pay, okay? So that's this is what basic trading, I think, starting with regulatory margin is great, because when you're doing a spread, you have your max loss down, and that's your max loss, is that 900 after the amount you receive, right? So the next thing how you can use it is to have 100% more buying power than you have in cash. So let's say you have $10,000, okay, and you buy 100 shares of XYZ that's trading for $100 a share, right? So how much money do you have left if you buy 100 shares at $100? You have $0 left, right? That is true, unless you were using margin, right? So if you're using margin, you actually have $10,000 more to use, and you can use that $10,000 to actually buy and sell options. No way. Yes, so I just bought ABC, right? ABC is like cash. That's how the brokers use that as that stock. They use stock as cash. You can liquidate that quickly, right? You can buy and sell stock quickly, right? So they're gonna treat this like cash. I would buy something like index, an SPY ETF or something like that, right? That's the S&P 500 ETF. And I know that's not going out of business, right? It's an ETF, it's an index. I know it's not going out of business. I know we're not going to have this CEO issue. I know the planes are not going to crash and it's going to cause the stock like Boeing to go down, right? I know that's not going to happen. But I want to use regulatory margin as leverage. So I'm going to buy SPY. It's the real symbol. SPY is the S&P 500 ETF index, okay? It trades just like a stock. It actually gives you a dividend as well, right? So I would buy that, right? And I'm cool with it going, if it goes up or down. But I have this 10,000, and I take that 10,000 and I go trade options, and I get premium. I'm selling put spreads, selling call spreads, what he's saying, and I'm collecting that $100, and that's coming into my account, and I get to keep it. Okay, that's a way you can use margin. I'm not saying you should do it, and I would encourage you to get a mentor or something before you start doing that. Or at least read a lot, learn, do the basics first. But this is just a way I'm trying to show you how you can use this margin, right? So the next point, it says for an easy loan, because you automatically qualify to withdraw equal to the amount you have in cash. So a lot of people don't understand, you can actually withdraw the cash from your broker's account, right? So the broker, you buy stock ABC, right? They're still gonna have $10,000 sitting on the side for you. You can literally take all that out, right, and go buy you you can go buy you a Prada bag or something, right? I don't recommend you do that, right?
You mean the
I don't
margin?
recommend you do that because that's, once again, that's a liability. Money's coming out of your pocket, and you still have to pay back the brokerage firm, right? But that is a very, very easy way to get a loan that you don't have to qualify for, right? As long as you have the money in your account, your brokerage firm will let you borrow, okay? So if you had that $10,000 on the side and you needed $5,000 for whatever, right? You can take that $5,000 out and do that, but obviously you're gonna have to give it back. And if your stock, if these shares fall below, right? Let's say the market tanks or something, and it goes below your 10,000. That's what these shares here. Then what you'll get what is called a what?
Margin call.
You get a margin call. And back in those days, they literally used to call you. Now they probably call you if you're really in trouble. Then email you out now. Email you and they'll tell you you need to liquidate some stuff or wire in some new cash. Right? So that you can literally borrow money from your account. All right. So the next thing, the last thing about this I want to discuss is to learn how to option margin can be dynamic by selling naked options. All right, so you can sell naked options, but I just say you had this here again, and let's say you wanted to sell this option here, just one. You're not doing a spread. The spread is when you buy something. Okay, so you're selling this one. Well, this just do this actually easier, easy math. Let's just say you sell this one. This is at the money, okay? You sell that from at the money, and when you sell that with regular T margin, the broker is going to require you to put up 20 to 30% in good faith payment. They're not going to require you to put up the whole amount. They only, in regular T margin, they only require you to do that on regular T margin. Okay, only on regular T margin. In this, if you sell a put, they're going to require you to put up 20 to 30%. So let's say it's 30%. So it's 30% of your max loss, right? So your max loss is $10,000 because you're selling at the 100. Okay, so they're going to require you to put up $3,000 to be able to do that trade. Okay, and that 3,000 can change. It's dynamic. It can change to 10,000 because that's your max loss. It can go to 0, or it can go all the way up. It can keep going up, and then that 30% can become less. Okay, it can become 20%, 10%, something like that. Okay, but a regular T margin is never going to become 0. So they're always going to require you to have a certain amount there, usually about 20%. Let's just move on to what is portfolio margin. Right? So portfolio margin is the newest type of margining system available to retail traders that started in 2007. Portfolio margin is designed to consider your entire portfolio and not just an individual position. It bases your risk after taking into account offsetting positions. Then it determines what will happen to your account if the overall market goes up or down 20% in one day. All right, so this is portfolio margin. This is the difference. We got calls to the left. I said y'all be repetitive. Puts to the right. This is the at the money line. We got 100, 110, 120, 130, 100, 90, 80, 70. And let's say you had this position of the put spread, right? And they were requiring $1,000 for you to do this spread. They're requiring you $1,000 on the regular T margin, remember? Because it's a 10-point wide spread. They were requiring 1,000 minus your credit, right? Well, with portfolio margin, they're going to require, instead of 1,000, they probably require 300. Okay? You only have to put up 300 to do that spread. All right? And then, when you, let's say you put on a new position and you sell a call spread here. You sell the 110, you buy the 120. So you sell, buy. This is a call spread because you're on the call side, the left-hand side. Okay? So with regular T margin, this is company ABC, this is company XYZ. For regular T margin, they will require how much for this? How much would they require regular T margin? This, what was that? 1,000. 1,000. Excellent. So they were regular T margin, they require 1,000 again for this, right? Because it's a different company, and so it's a new trade to them, right? With portfolio margin, this is a long position. You want it to go up. This is a short position. You sold a call. Remember, when you sell a call, you're bearish. You're bearish, right? So with portfolio margin, it didn't take into account that ABC is long, XYZ is short. So it might require 100, if that, to do this trade. Okay? It might require 100 to do that. All right? So now you've used only $400 of your 10,000. Portfolio margin bases it offsets these positions. This is how it offsets it, right? It says, okay, you have something long here, something short there, but it also measures your account up or down 20%. So what would happen to your overall portfolio if the market went up 20% in one day, and what would happen if it went down 20% in one day? Okay? And so if it went down 20% one day, they base it on 2 times your account. So if your account is $100,000, and through their calculations, if your account will be you will lose more than 2 times your account, or 200,000 at 20% down, then they will give you a margin call. They'll send you an email and say you have to clear up some stuff, right? You have to take off some things or add some more cash, because they don't want you to use too much leverage, right? They don't want you to lose more than twice your account, 20% down. A 20% move is very, very, very rare now with stock indexes, because you have circuit breakers, okay? You have circuit breaker at 7%, 10%, I think 15% or something like that, right? I know it's the initial one is 7%, after hours it's 5%. I've seen that happen a number of times, 5% down after hours, okay? So, but that's what portfolio margin, the key to, one of the big things about portfolio margin is the last point here, is because portfolio margin is considering your entire portfolio, the margin requirements are lower and the leverage available is a lot more, right? To qualify though, for portfolio margin, you need to have an account of 125K in your account or maintain 100K, okay? So to qualify, you need to have 125K at least for portfolio margin, right? Let's move on to what I love, right? What is span margin? The standard portfolio analysis of a risk system is known as span margin, and it is a sophisticated methodology that calculates performance bond or buying power requirements by analyzing the what-ifs of virtually any market scenario. Span margin is the margin used in futures markets, and it has been around since 1988. Span margin was created by the CME, which is the Chicago Merchants Exchange. Okay, so span margin is the original portfolio margin. Span margin is better than portfolio margin. And span margin is available to anyone with $2,000. Available to anyone with $2,000. This is what I teach most people to trade when they're learning with me one-on-one, is how to use span margin. Teaching responsibly, obviously, because you need to be responsible when you're using leverage, but this is how you can take a small account and make some really good returns, okay? Avoid short-term capital gains rates because trading with span margin qualifies for 1256 contract tax treatment, which is 60% long-term, 40% short-term, okay? So span margin allows you to have a tax break because it's so many companies that are trading the futures markets, okay? There's people that are trying to hedge. You have companies like Southwest Airlines, American Airlines, where they're trying to hedge their oil prices so they go to the futures, okay? You have farmers that go to the futures to hedge their crops, the hedging grain, hedging wheat, hedging soybeans, okay? And so the government has encouraged them or gave them a tax break, and they are encouraged speculators by allowing speculators to have that tax break as well. The highest tax bracket is 37%. Okay, 37%. 1256 contracts tax you at 60% long term, because if you're trading, right? If you're trading options, you're probably staying in it for less than a year, right? So when you're trading stuff for less than a year, you have long-term, you have short-term capital gains, right? But with 1256 contracts, it's 60% long-term, 40% short-term. All right, so let's say you made $100. And you're going to have to pay taxes on 60% of that. 6% of that's going to be considered long-term cap gains, right? So let's say $60, right? And let's say you're in the highest tax bracket, so your capital gains rate is 20%, right? The capital gains rate is 0, 15, and 20%, okay? 0, 15, and 20%. So 60% of this $100 you made is going to be at long-term capital gains rates, which for this person, because he's in the highest tax bracket rate, they're making a lot of money, 30%, 37%. So it's going to be 20%. So $60 is going to be taxed at 20%. So times 20%. All right, so that's $12. So $12 is going to be taxed. So you got that's how much you're gonna have to be taxed at. That's 60%. Let's see if I can do that right. Then you got $40 that's gonna be taxed at your long-term capital gains rate. Do anyone know what the long-term capital gains rate is? that is your ordinary tax rate. So that 37% that I was talking about. So $40 times 37% is 14.8, but it just says 15. Okay? So you have the 27, right? It's a little less than 27. But if you are in the highest tax bracket rate, right, you can trade in and out of stocks all day, and instead of paying 37%, you will pay 27%. It's actually a little less than 27%. It's like 26 something, okay? But that is the benefit. And at the end of the year, it's all market to market. You get a tax form from your broker, and if it says you made $100, that's what you put. That's what you give to your CPA, or that's what you put in your TurboTax. Is that $100, right? If you're trading stocks, you're gonna have to do what is called cost basis. So you have to keep all your documents of everything you're buying and selling, okay? And you have to include that in your taxes, because you have to account for your cost basis, okay?